everyone. It's Tuesday, April 4th. Today on the Final Bar, I'll be talking with Jeff Hughes, founder of JWH Investments. We'll talk about the overall structure of this market, some of the concerns about narrow leadership and how that relates to movements that we've seen elsewhere. Today, a lot of things moving lower, particularly industrials. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. When I was learning about this whole investing thing a couple of years ago, I was taught that technical analysis was the way to understand the rhythm of the market. So really what investors were thinking, what they were feeling, what they were excited about, what they were nervous about, because all of those things were reflected in stock prices. And I've certainly found that in practice over the course of my career. Today and every day on the show, we try to share with you just some of the observations that we're making using the technical toolkit, using the StockCharts platform, and really trying to understand the market dynamics. We're at sort of an interesting juncture right now, right? If you ignore what's happening in the markets and think purely about the seasonality, April's a pretty strong month on average, particularly in a pre-election year. So it may sort of exude confidence or imply confidence that the markets are probably in pretty good shape. Charts like Microsoft kind of holding up there okay, despite the fact that the markets are overall are sort of challenged. This is getting us to that sort of disconnect between a relatively small number of strong mega cap names in certain growth sectors versus the average stock that's out there. And today you're seeing a big differentiation with things like materials, energy, and industrials struggling. We're going to dig into those charts in a little more detail. We have a great guest today, Jeff Hughes, to help us try to fill in some more detail with what I just described. Let's get it started today with our market recap. And we'll look through some of the charts together. As I implied, sort of a choppy day today. And at the end of the day, even though there's a bit of a bounce going into the close, end of the day, pretty weak. Generally speaking, relative to what we've seen recently here with some strength in the second half of March. Today, the S&P 500 closing just above 4,100, just narrowly, and that's down about 0.6% from yesterday's close. The NASDAQ 100 down a little bit less, but still down about 1/3% to 13,100. Mid caps and small caps down in a much more significant way. And a lot of that you could probably attribute to the sector distribution and those sorts of things, a little more exposure to some of the sectors that were struggling today. So the small cap ETF, the S&P 600, down almost 2%. The VIX, by the way, pushing back to the upside, still below 20, and 20, while not a hard and fast rule of sorts, that's just sort of my back of the envelope thing. I mean, things like the VIX and others, I'm thinking of like the ARMS index, or what you call the TRIN index, and other things. It's sort of a quick glance. Is the McClellan oscillator above or below zero? Is the TRIN positive or negative? Is the VIX above or below 20? And so some of the basic questions you can answer with a number that just gives you a sense. If you answer all those questions, you kind of get a sense of what the conditions are. So the fact that the volatility is still below 20 tells me overall this is not a very volatile market. If I generally would compare what we're seeing, recently with the big picture, it certainly felt like a lot more volatility than the VIX would imply. But for what it's worth, the VIX remaining below 20, even with today's drop and the push higher in the VIX. Interest rates, for the most part, moving lower. You can see 10-year yields are down almost 0.1 to 334. Long bonds still at around 3.6. The dollar index actually bouncing lower, pushing a little bit lower today as bond prices rallied. So stocks down, bonds up, dollar down. Looking at commodities, though, you see there are some spots of green on here. And again, what's interesting about a day like today, when it feels like a lot of things are down, which it certainly is, always interesting to just immediately look at what's up, right? What actually bucked the trend and was able to register a positive day when the average thing was sort of struggling. Gold, silver jump off the page at me so far. Precious metals, we talked about how, the overall trend in commodities, certainly the trend in crude oil, has diverged a bit, in some ways, much more than a bit from things like gold and silver. And on yesterday's show, we focused a lot on energy because of that big gap higher in crude oil prices, big gap higher in a lot of energy stocks. When we look at the energy stocks here in a minute, you'll see that a lot of them gave back yesterday's gains, in some cases a little bit more, as things sort of came back to earth. But certain parts of the commodity space, particularly gold and silver, holding up there okay. Cryptocurrencies mixed for the most part, but overall, I would say net positive, with Bitcoin and Ether prices moving higher. Again, it's so interesting to see them diverge from the equity markets. For a while now, I think there's a question mark as to what cryptocurrencies represented. Are they a risk asset? Are they a risk-free asset? Certainly, I can't imagine you would answer yes to that. But do they, trade? Do they move more like the dollar? Do they move more like stocks? Do they move more like bonds? And what you're finding now is they're certainly diverging from equities. For a while there, it was sort of equities up, crypto's up, equities down, crypto's down, and it was sort of just a move on speculation, similar to what you would see maybe with equities, but very, very different now, where you're seeing cryptocurrencies actually holding up and still fairly constructive. It looks more like gold, to be honest with you, than something like the S&P or the NASDAQ at the moment. Let's look at a daily chart of the S&P just to see what happened today and relative to what that means. What's concerning, if you're all bulled up and you see the S&P above 4,100 and you think this is lights out, we're going to 5,000 in the next couple of weeks. Again, pretty unrealistic. But if you're all bulled up, what would concern me is the fact that we have a bearish outside day on the S&P 500. I'll zoom in just a little bit so you can see what I mean. Now, bar chart analysis is basically using the open, high, low, close bars and just sort of thinking about what those bars represent in the day-to-day sentiment of the markets. If you look at what happened today versus what happened yesterday, it's called a bearish outside day. And what that means is you have a big up day and a big down day, and the range of day two is wider than day one. So think about what that means, right? Market moving higher over the last couple of weeks. You have yesterday, nice move higher. Again, not a dramatic upswing of 5%, but decently continuing the uptrend. Today, we open a little bit higher, but we close lower, right? So initial sense that this was further follow through to the upside is sort of messed up, or is sort of denied as sellers actually come in, or there's an exhaustion of buyers, whatever it is, causes prices to go lower, and we're back down at 4,100, pretty much at yesterday's open. If you're a candlestick aficionado, this will look very familiar as a bearish engulfing pattern, right? Which is where you have an up candle and a down candle. With candle speak, you have to look at the body, or what's called the real body, which is the open to close range. And you can see that the body of today's candle engulfs the body of the first candle. That's what's a bearish engulfing pattern. So candles call it a bearish engulfing pattern. With bar charts, you just call it a bearish outside day. In either way, it's not good. And now keep in mind, this is not a long-term, okay, that's the top. That just means in the short term, the sentiment usually over the next 1 to 3 bars is more likely negative than positive. That's how I learned it, and that's how I've sort of thought of it. So very interesting to me as the S&P is retesting this resistance area from early February. We literally got above 4,100, which puts us right in the range of where we topped out about 2 months ago. We have a bearish engulfing pattern, which suggests, at least for now, short-term weakness. Now, it doesn't take much, to be honest, for the market to negate that. You just need to get above today's high, and it all of a sudden looks just like a brief pause before continuation. But that's sort of the bias that I'm thinking about in the short term, is that sort of short-term distribution pattern. It's compounded by the fact today that is overall sort of defense working. If you look at the 11 S&P sectors, only 2 of them really finishing in the green. Utilities, number one, and anytime utilities are leading the way higher, it's not a feel-good sort of all bulled up sort of day. That is more of a defensive sector, something that usually is thriving a little bit more in a bearish environment than a bullish environment. Although not always, and there have been times when defensive sectors like utilities or real estate do fine in a bull market. But for what it's worth, on average, it's sort of like small caps underperforming. It's not just a confirmational thing. It's sort of it's a red flag of sorts for me to revisit what's actually working and what's not. Communication services, number 2, and that's notable, up about 1/3%. REITs and healthcare were flat for the day. Everything else in the red. Now, if you look at what's at the bottom of the list today, I think that's the area really to focus on. Industrials down over 2%, energy down about 1.8%, materials down 1.4%. Now, those aren't end of the world sorts of numbers, but when you think about what we were talking about yesterday, which is a gap higher in energy, stocks like ConocoPhillips and DVN and FANG and fill in an energy ticker here, sort of gapping higher. What we talk about was it's not just enough to gap higher. It's about the follow through, right? It's about, now that we've reestablished this sort of proper valuation for the stock, do additional buyers come in, and are they willing to pay more than that gapped value to pay more for it? Today, you're actually seeing not so much. We're actually sort of retracing a bit after yesterday's jump. Now let's look at a couple of these charts here in a little more detail. We'll see what sort of patterns we can see. Before we get to the individual charts, I did want to mention the dollar index, because the dollar is off a little bit today. And if you look, we're looking at the UUP, which is a dollar ETF. We'll look at the dollar index. I just want to do that to show that, UUP down about 0.4%. UUP is testing support from January. The chart I like to use looking more at long-term trends is this one, $USD, which is the US dollar index. So it's sort of the dollar weighted against different things like the euro and the yen and other currencies globally, sort of some of the big ones that you would compare it to. If you look at what's happened, January, February, March, down January, up February, down March, it's sort of the opposite of what you saw with stocks, right? With sort of a nice move out of the new year with a strong January. February was actually a drop in the S&P 500 coming off of that peak in early February, and then we saw the rally that started kind of a week or two into the month of March. The opposite is what we've seen with the dollar, and one of the reasons why I think that's important is, I would argue that maybe the bear case for stocks would involve the dollar sort of finding support and rotating higher. In general, when the dollar's been strengthening, it's not been great for risk assets, particular equities. So the fact that the dollar's remaining low is certainly providing a room for certain equities to do well. And also, I would argue that that we called the dollar the wrecking ball for risk assets, because so often when the dollar was strong, it was difficult for anything else to kind of do well. So this might be one of the charts to watch as we begin this month of April and see if the market rallies in the tendency that tends to happen seasonally. We'll see if we see that additional strength, but I would need to see the dollar bounce higher. Well, I'm a little long on time, but I just want to show one chart here there to finish off, which is MPC. This is Marathon Petroleum. We could look at Valero. We could look at Caterpillar, Deere, URI. Those are some industrial stocks. What concerns me about these areas, what we call the MEI sectors, they're all down pretty significantly today. Marathon Petroleum down almost, let's say, over 7%. So what's interesting is MPC is coming off of a new 52-week closing high yesterday. So a lot of these stocks that actually have been showing strength in a sector like energy, giving back a lot of these. So while it's not a new downtrend yet, I would say arguably that the uptrend is still in place. We're really trading down to the lower end of this range very, very quickly. That's a space to watch, certainly through the remainder of this week, as we give back some of the gains we had yesterday with the gap higher. Let's take a quick commercial break. We'll bring on Jeff Hughes of JWH Investments. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close. It's a pleasure to do the show for you. Before we bring on today's guest, Jeff Hughes, I want to make a couple quick announcements. First off, we're going to do a mailbag on Friday's show, also Monday of next week. Those questions all come from viewers like you, trying to use technical analysis, running into questions, and sharing them with us. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to hear from you and answer your question live on the air on Friday's show. Upcoming schedule, just so you know, tomorrow we have a really good guest. Tony Dwyer's the chief strategist at Canaccord Genuity. Fantastic strategist, really knows the macro environment well. And I love talking with Tony about what we're seeing on the charts, how that relates to what he's seeing in a lot of his conversations with institutional investors, looking at the Fed and some of the economic data. So don't miss that conversation tomorrow. On Thursday, April 6th, one of my favorite pure stock pickers, Joe Rabel, founder of Rabel Stock Research, is a fantastic guest. He'll be joining us on Thursday. And then, as I mentioned, the mailbag will be coming up this Friday. So make sure you share your questions with us as soon as you can. Want to welcome on today's guest, Jeff Hughes. Jeff has been a frequent guest on StockCharts TV and on our show, The Final Bar. Is the Chief Investment Officer at JWH Investments, founder of Alpha Insights, which is an institutional newsletter, also the publisher of Huge Insights, which is a new retail-oriented newsletter, which I certainly encourage you to check out. Jeff, it's great to see you. Welcome back to the show.
It's great to be here, Dave. Thanks for having me.
So we've been talking certainly in recent days and recent weeks about sort of the leadership characteristics and what's been happening here recently. Feels like a narrow market in some ways, but let's look through some of the charts that you've shared with us. How would you describe this market, starting with your look at performance over the last month, right?
Yeah, I guess I would punctuate it this way. Technology was the leader, up 10.9%. Financials were down 10%. I mean, if you removed financials, the market would have been much stronger. And if you remove technology, the market would have been much weaker, right? The averages. If you really take a look at what's going on, outside of that, you can take a look at the NASDAQ 100 as really kind of being the driver. But if you look at the NASDAQ 100 equally weighted, it's nowhere near as strong as, the top cap weighted names that make up about 50% of that index. And we'll talk about that in a second. The other thing that I think is noteworthy is that, the S&P, while up 3.7% in the month of March, actually, if you look at the average stock, it was down 1.1% in the month of March. And a lot of that has to do with the concentration, again, in those top 10 stocks, which accounted for about 90% of the gains in the S&P 500. In fact, the top 3 stocks in the S&P accounted for 50% of the gains. And when you look at mid caps and small caps, I mean, they were sharply lower, with small caps down almost 5%.
That is such a brilliant visualization. I actually didn't realize that happened, where the S&P was positive, but the equal weight S&P negative. That's one of those really sort of counterintuitive. It tells a really interesting story about the sort of top heaviness, I guess, a lot of the returns that we've seen. It's a really good chart. Second one is really looking at some of the individual names that break that down. This is year-to-date returns here, right?
Right. The first one was month of March. This is year-to-date, so the first quarter. And as you can see, NVIDIA was up 90%. That was one of the key leadership stocks, and one of the top 3 stocks responsible for gains in the S&P in the month of March. And, if you add to that the simple fact that, Apple, Microsoft combined 13% weighting in the S&P 500 and almost 25% in the NASDAQ 100, couple that with the next few names: Tesla, Meta, Google, Amazon. I think you can throw CRM, AMD, and Broadcom in there. We haven't shown those on the chart. But at the end of the day, the performance of those stocks dwarfed the S&P 500, actually dwarfed the NASDAQ 100 as well, and certainly dwarfed the average stock, which was up only 2.4%. In other words, the S&P equal weight index is only up 2.4% in the first quarter. I mean, for all the talk of a new bull market, that's not that impressive, from my perspective anyways.
These are some really interesting visuals that kind of tell the story of how things have played out. We have had that, situation, I guess, recently. 2021, I guess, comes to mind, where, the market can rally with narrow leadership. Why, in your mind, is that a bad thing, right? If it's so narrow? I mean, if you're an investor, why would that be a red flag of sorts? Why is it important to see broader participation, I guess, is another way to ask it.
Well, if the generals are charging the hill and the infantry is retreating, I don't think the generals can win the war on their own,
Fair point, right? Okay. I love it. Let's get to your other charts here. So you have some charts that really tell the story of breadth a little bit better. This is the NASDAQ Composite daily chart. Can you talk us through this one?
Yeah, so we're looking back a couple of years here. We can see that there was a march to new highs from around, say early 2021 into the 2022 highs, right? But as that march occurred in the broad NASDAQ index, and that's about 3,400 stocks, mind you, you could see that the advanced decline line, which is the middle frame, the NASDAQ AD line, was making significantly lower highs as price was making new highs. So it was unconfirmed by the breadth of the market. And if you go to the bottom panel, you can also see that new highs failed to really support the notion of a new high. And I think that was kind of the indication that things were running out of steam. There was no fuel left in the tank. So what I'm seeing right now is we just saw a new recovery high in the NASDAQ composite. And as we were saying before, it's NASDAQ stocks that are leading the market, right? But even when we look at the NASDAQ itself, the breadth is exceptionally narrow. In fact, the AD line is nowhere near making a new recovery high. And if we take a look at net advancing, or I should say net new highs rather, in the NASDAQ, again, nowhere near confirming those new highs in price. That to me is a serious warning signal, a shot across the bow that, the tank is running on empty at this point.
Really, really interesting. I love that illustration of the 2021, really into 2022 at the peak. And it's so interesting. This is when the S&P is making a new high at this point, right? Is when this divergence is sort of happening. Speaking of which, we have a weekly chart of the S&P. I have a sense, we haven't talked about this one yet, but I'm getting a sense of where we may be headed according to this analysis. Talk us through the narrative here.
Yeah, so there's a lot of talk about a new bull market in the S&P 500. Some people are talking about a inverted head and shoulders bottom. I hear that all the time and read it on Twitter. People are seeing head and shoulders everywhere they look. It's crazy. I just don't see it, Dave. What I see is a 5-point reversal pattern, more commonly referenced in the nomenclature of technical analysis as a symmetrical triangle. And, I actually teach a class, exam preparation class for level 2 and level 3. And one of the concepts that we talk about in level 2 in pattern recognition is how the symmetrical triangle is it's a consolidation, lateral consolidation pattern, but it's also a continuation pattern. And what that means is that it tends to resolve in the direction of the previous trend. And so, we're looking at the trend off the 2022 highs into, say, the June lows as being kind of the prior trend clearly to the downside. Since about May 1st, actually, we've gone net sideways. And it looks to me like we're completing that 5-point reversal pattern, which in my mind looks like a symmetrical triangle. I believe it will resolve to the downside. And I think today's kind of bearish key reversal day that you were discussing earlier is probably part and parcel, right? We ran right into that trend line and reversed. We ran right into the 50% retracement level today as well and reversed. And I think if we take out the lower boundary of that triangle, all bets are off. What's also interesting is that you can see, again, the percentage of stocks in the S&P 500 that are trading above their 50-day moving average is de minimis. It's turning down, and it's not supporting the new highs in price. And the simple fact that the average stock is underperforming the index, again, speaks to this, collapse in breadth that's evident in the broader S&P.
Jeff, because you've described yourself as an educator, which I think you are as well equipped as anyone I know to do so, can you explain why it's important? You mentioned breaking through the lower end of the triangle. Why is that an important, point to focus on when you're seeing this sort of pattern emerge?
Well, in technical analysis, breaching a trend line is a critical point. And I would say, by breaching that lower boundary, that's the initial evidence that the pattern is poised to resolve in the opposite direction, right? And finally, if we take out that lower low, or I should say that higher low, the point that I would mark as D, that would confirm it. And so, right in there is where we want to look for confirmation of a downside resolution.
Yeah, you and I, Jeff, I know have found probably the same thing on social media and elsewhere. A lot of people, it's very easy to find patterns and describe them, but it's all about that trigger, right? It's all about that point at which it's confirmed. I think that's a really key part here. So I have to ask, Jeff, we have about a minute left. Given the scenario you've talked about, given the potential to go downside, where do you look, right? Where's an opportunity? How do you ride out this sort of environment?
I think a great insurance policy for this type of a market where you have, a developing risk of financial contagion in the banking system. And by the way, you don't get a new bull market in stocks when banks are making new lows, okay? But let's just start with where to hide. I think gold is a great opportunity right now. Gold just posted a new monthly and quarterly high on March 31st. Record monthly and quarterly high. And in my mind, that confirms the breakout of this pattern here, this consolidation pattern. We've been looking at it for a while and recommending it for a while, but we upgraded to a strong strategic bullish recommendation for gold. And we have a $2,500 target for gold near term. What I also would point out is I think a great pair trade would be short the S&P 500, long gold. And I think you cover that trade when both of them hit 2,500 simultaneously. 2,500 on the S&P index would be in the wheelhouse of our downside target. And I think $2,500 on the price of gold will coincide with that. And I think that'll be a great pair trade.
Jeff, that was awesome. That was like a masterclass in sort of the overall conditions, the narrow leadership, which is true, but then applying what I love it. That was the CMT thumbs up. If that's your exam prep, I would say, because I love how you line that up with the pattern recognition and what you would need to see to turn negative. Jeff, awesome to see you. Thanks for coming on, and stay safe there in Minnesota. All right.
Thanks, Dave. Always a pleasure.
That's Jeff Huge. Jeff is the Chief Investment Officer at JWH Investments. He has an institutional newsletter he's been running successfully for a number of years called Alpha Insights. He's also the publisher of a newer retail-oriented newsletter called Huge Insights. You can find more info on that at hugeinsights.substack.com. He's also hosting Your Daily 5 on StockCharts TV tomorrow. So he promised he would also have some other really cool ideas, which we didn't share with you today, which we'll have for you on Your Daily 5 tomorrow. So make sure you check that out as well. Great take there, as always, by Jeff Huge. We need to wrap the show, folks, and go to the 3 in 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Chart number 1, I have to start with the S&P 500 and what we would call a bearish outside day or a bearish engulfing pattern, depending on whether you use candle charts or bar charts. In either case, it's not an encouraging sign. Now, Having said that, right, my conversation with Jeff, talking about some of the longer term patterns, the symmetrical triangle, which has been evolving for some months, what a breakdown might mean. This is more of a short term pattern, right? Candlestick analysis, short term bar chart analysis is more about tactical movements and short term sentiment. What it tells me is the next 1 to 3 bars more likely lower than higher. Steve Nissen, who is credited with introducing this Japanese form of analysis called candlesticks with the West, always used to tell me using the upper end of this 2-day pattern is always a really good sort of natural stop. So SPY gets above 412. I think all bets are off on this, but for now, it's telling me weaker over stronger. And you're certainly seeing that when you look at certain sectors like materials, energy, and industrials. Chart number 2 is fixed income markets. It's interesting thinking about Jeff Huge's take on sort of a bearish read on stocks, which I get the argument. And I love how he was illustrating some of the conditions that would really have to persist to sort of create that environment he was talking about. I wonder if bonds or something like that would rally. Bonds, gold, some of those traditional safe haven plays may thrive. Rates have remained relatively low compared to the last couple months. The TLT, the AG, actually very close to making a new high for the year. So interesting to see if TLT will continue to improve. The momentum is something I'm looking at on this particular chart. The RSI is right at 60, which is sort of the upper boundary of what you'd expect if the trend remains bullish, right? If it remains bearish. If we get above 60, if the market rallies, we break out on higher momentum, that all of a sudden turns us into a much more bullish configuration of a chart. Chart number 3. Oh, I didn't put it on here. The GLD. The GLD, I loved Jeff's take on gold, and I was wondering what he would say when we asked about where to be in this place. We've been talking about the idea of gold. What I think is interesting about the GLD is that it is breaking out in an environment where the S&P is below its swing highs, where the NASDAQ is below its swing highs. When energy, industrials, materials are struggling, what stocks or what charts of anywhere are actually making new highs for the year? Enter gold, which is getting it done today. Folks, that's a wrap for the show. I want to thank Jeff Huge of JWH Investments joining us from Minnesota. All of our previous interviews are at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a good night. See you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.